Picture someone worth $40 million walking into a bank to buy a $5 million house. You'd assume they just pay for it. Write a check, wire the money, done. Instead, they sit down with a loan officer and take out a mortgage. Here's the part that should genuinely confuse you. They didn't need the loan. They had the cash sitting right there. So why would someone with more than enough money choose to borrow instead of just paying?
Same story with the car in the driveway. Somebody with real money finances it at 0% instead of paying cash outright, even though the cash is sitting in an account earning basically nothing. On the surface, this looks completely backwards. Shouldn't having more money mean you pay things off faster, not slower? Shouldn't debt be the thing you avoid once you can actually afford not to have it? It turns out the opposite is closer to true. And once you understand why, you'll never look at a cash purchase the same way again. This isn't about being flashy or disconnected from real money. It's a deliberate, mechanical strategy. And by the end of this video, you'll understand exactly how it works.
Here's the idea that unlocks the whole video. Holding cash isn't free. It feels free because nothing visibly leaves your account. But cash sitting idle is quietly costing you money in two separate ways at once, and most people have never had either one explained clearly. The first cost is called opportunity cost, and it's simpler than the name makes it sound. Every dollar you leave sitting in a checking account is a dollar that isn't out in the world doing something else, earning a return somewhere, growing in value, generating income. If that same dollar were invested and earning, say, 8% a year on average, then leaving it in cash instead isn't neutral. It's actively costing you the 8% you didn't earn. Multiply that across millions of dollars, across years, and you're not just not gaining. You're missing out on genuinely enormous amounts of money purely by choosing to sit still.
The second cost is inflation. And this one's even sneakier because it actively shrinks the number, even while the number on your statement stays exactly the same. If inflation runs around 3% in a given year, $100 sitting in cash can buy roughly $3 less worth of stuff by the end of that year than it could at the start. Your balance didn't change. Your actual purchasing power did. Cash isn't a safe harbor sitting outside the economy. It's still fully exposed to this slow erosion. It just doesn't announce it the way a stock market dip does. Put these two together, and here's the uncomfortable math. Someone holding a large amount of idle cash isn't preserving their wealth. They're actively losing ground every single year in a way that never shows up as a scary red number, which is exactly why most people never notice it happening. For someone with a few $100s in a checking account, none of this matters much in practical terms. But for someone with millions sitting in cash, this invisible cost becomes a genuinely massive amount of real money year after year. And that's exactly the gap wealthy people are trying to close. So if holding cash is quietly expensive, what's the alternative? This is where the concept of leverage comes in. And it's genuinely one of the most important ideas in all of personal finance, even though most people have only ever heard the word without understanding the mechanic underneath it. Leverage means borrowing money at one interest rate and using that borrowed money to do something that earns you a higher return than what you're paying to borrow it. That's the entire concept. It sounds almost too simple. But this single idea is behind an enormous share of how large fortunes actually operate day to day. Let's go back to that $5 million house. Instead of paying cash, our hypothetical buyer takes out a mortgage at, say, 5% interest. Now here's the key move. The $5 million that didn't go into the house stays invested somewhere else, earning an average return of, say, 8% a year. The buyer is paying 5% to borrow while earning 8% on the money they kept invested instead. That 3% gap applied to $5 million is real money showing up every single year
purely because they chose to borrow instead of pay cash.
This only works, obviously, if the return on the money you keep invested is genuinely higher than the interest rate you're paying to borrow. If borrowing costs were higher than expected investment returns, this whole strategy would work in reverse, and it sometimes does, which is exactly why this isn't free money, and why getting the direction of that gap wrong is how leverage turns from a smart strategy into a genuinely dangerous one. But when the gap runs in your favor, and you have enough assets that the math meaningfully applies, borrowing instead of paying cash isn't reckless. It's just following the math to its logical conclusion.
This is also why you'll see wealthy people take out loans against assets they already own, rather than sell those assets to raise cash. If you own stock that's grown enormously in value, selling it to buy something means giving up your entire position in an asset that's still working for you. And, as we're about to get into, potentially triggering a tax bill in the process. Borrowing against that stock instead means the stock keeps growing, keeps working, and you still get access to spendable cash right now. You're using the asset as collateral rather than converting it into cash and losing its future growth entirely.
Real quick, if this is the kind of thing you like having actually explained instead of just repeated as a talking point, that's genuinely most of what we do here. Subscribing to Compound Economy means you catch the next one, and it helps a lot on our end. Okay, because the tax piece of this strategy is where it gets genuinely clever, and it's the part almost nobody explains correctly.
Here's a detail that changes the whole picture. Borrowed money is generally not considered taxable income. This sounds almost too simple to matter, but it's actually one of the most important quiet advantages in this entire strategy. When you earn a paycheck, that's income, and it gets taxed. When you sell an investment for a profit, that's a capital gain, and it generally gets taxed too. But when you borrow money against a house, against a stock portfolio, against any asset you already own, that loan is not income. You didn't earn it, you didn't sell anything to get it, so there's nothing to tax. You can spend that borrowed money on almost anything you want, and the tax bill for that spending simply doesn't exist. At least not yet, and often not ever in the way you'd expect.
This is a genuinely huge deal for someone whose wealth is mostly tied up in assets rather than a regular paycheck. If most of your net worth is in stock or real estate or a business you own, converting any of that into spendable cash by selling it typically means paying capital gains tax on the growth. But borrowing against that same asset, using it purely as collateral, sidesteps that tax event entirely, while the underlying asset keeps growing and keeps counting toward your net worth.
There's a second piece to this, too. Interest paid on certain kinds of debt can, depending on the specific situation and current tax rules, be deductible, meaning it actually reduces your taxable income rather than just being a cost with no offsetting benefit. The exact rules here are genuinely complicated and vary a lot by situation, so this isn't a blanket all debt is tax deductible claim. But the broader pattern holds. Structuring a purchase through debt rather than cash can sometimes create a real tax advantage on top of the leverage advantage we just covered, stacking two separate benefits into a single financial decision. Put opportunity cost, leverage, and this tax treatment together, and you start to see why just pay cash, which sounds like the responsible, simple choice, can actually be the more expensive path once you're operating at a scale where these effects add up to real money.
All of this comes together into a specific, well-documented strategy that estate planners and wealth advisors actually have a name for: buy, borrow, die. Here's how it works, step by step. Step 1, buy appreciating assets. Stock, real estate, ownership in a business, things that grow in value over time. Step 2, instead of ever selling those assets to access cash, which would trigger capital gains tax, borrow against them instead, using them purely as collateral for loans. That borrowed money is spendable, tax-free at the moment it's received, exactly like we covered in the last chapter. Step 3,
And this is the part that surprises people the most. When the original owner eventually passes away, in many tax systems, the assets get what's called a step-up in basis, meaning for tax purposes, the asset's value resets to what it's worth at the time of death, rather than what it was originally bought for.
What that step up means in practice is genuinely striking. All of that growth that happened over the original owner's lifetime, the entire gain that would have been taxed if it had ever been sold, can, in many cases, simply never get taxed at all. The heirs inherit the asset at its current value, sell it if they want to without owing tax on the growth that already happened, and the loans that were taken out along the way get paid off from the estate. The wealth moved from one generation to the next, was spent on along the way through borrowed money, and a huge portion of the actual growth in value never triggered the tax bill that a normal sale would have created.
This is exactly why you'll sometimes hear that some of the largest fortunes in the world have paid remarkably little in taxes relative to how much their wealth actually grew. Not through anything illegal or hidden, but through this exact legal structure applied patiently over decades. Buy assets, borrow instead of sell, let the assets keep growing, and let the tax treatment at death handle the rest. Here's the part that's genuinely important to say clearly, because it's easy to walk away from a strategy like this thinking it applies to everyone, and it really doesn't. This entire approach depends on having real, substantial assets to use as collateral in the first place. A bank isn't going to lend someone money against a stock portfolio they don't have or a house they haven't bought yet. The whole borrow instead of sell strategy assumes you already own something valuable enough and stable enough that a lender is comfortable using it as security. For most people, that kind of asset base simply doesn't exist yet, which means most of this strategy isn't actually available to them in any meaningful way, no matter how well they understand the mechanics.
There's also a real risk sitting underneath all of this that doesn't get talked about enough. Leverage cuts both ways. If the assets used as collateral drop in value significantly, a lender can issue what's called a margin call, demanding either more collateral or repayment of the loan, sometimes on short notice. Someone who's borrowed heavily against assets that suddenly lose value can end up in a genuinely dangerous financial position, forced to sell at exactly the worst possible moment to cover a loan they took out specifically to avoid selling in the first place. This strategy isn't risk-free just because wealthy people use it. It's a trade-off, and the people using it successfully are generally managing that risk carefully, with a level of financial cushion most people simply don't have.
So this isn't really a story about a trick everyone's missing out on. It's a story about how the math changes once you already have significant assets. The same underlying principles of opportunity cost, leverage, and tax treatment exist at every scale, but the actual strategy of borrow instead of sell forever genuinely requires a foundation most people haven't built yet. And rushing into heavy borrowing without that foundation is how this same strategy turns into a real financial disaster instead of a smart one.
None of this means the takeaway is go into debt. That would be exactly the wrong lesson. And applying a billionaire's leverage strategy to a much smaller, much less stable financial position is a genuinely common way people get themselves into real trouble.
But a few of the underlying ideas do scale down in useful ways. Understanding that idle cash has a real, ongoing cost, even if it's a small one at your scale, is worth knowing because it changes how you think about money sitting in an account for years with no purpose. Understanding that debt isn't automatically bad, and that the real question is always whether the money is being borrowed at a lower rate than it could reasonably earn elsewhere, is a genuinely useful lens, even for something as ordinary as deciding whether to pay off a low-interest loan early or invest that money instead. And understanding that selling an appreciating asset can trigger a tax bill that borrowing against it might avoid is worth knowing even at a modest scale, long before anyone's talking about generational wealth or estate planning.
The core lesson isn't never use cash. It's that cash, debt, and assets aren't simply good or bad in isolation. They're tools. And the wealthy aren't avoiding cash because they've got some secret. They're just running the actual math at a scale where the math adds up to real money, instead of following the simple rule most of us grew up with that paying cash is always the responsible choice. If you found this useful, subscribe to Compound Economy.